looking at the momentum of economic activity, looking at a few early data points which have come in, a few early indicators, I can say that the second quarter GDP number, as and when it is released at the end of November, in all probability will surprise everyone on the upside.
Clearly, RBI Governor Shaktikanta Das foresaw it. Speaking at Business Standards BFSI Summit on October 31, Governor Das had said that there was a surprise in store. And on the evening of 30th November, when the National Statistical Office came out with a fresh set of macroeconomic data, most analysts were indeed surprised. India's gross domestic product or GDP for the second quarter of financial year 2023-24 grew by an impressive 7.6% year-on-year. It was a tad lower than the 7.8% GDP recorded in the first quarter, but higher than the 5.4% growth rate recorded in the same quarter last year. This takes the first half GDP growth to a robust 7.7%. The July-September quarter GDP number was also way above the Monetary Policy Committee's projection of 6.5%. The surprise was largely led by the manufacturing and construction sector. The highest growth was registered in the manufacturing sector. It surged to a 9-quarter high of 13.9% in Q2, up from 4.7% in Q1 of FY24. This was followed by the construction industry that recorded 13.3% growth in Q2 as against 7.9% in Q1 of the current financial year.
I would say that it also has come as a big surprise for us because we were looking at 6.5, 6.6%. So getting 100 basis points higher than expectations sounds too good to be true, but it is true. I think that's the important thing. Now, why has it come about? I would tend to think that the manufacturing sector is something which has given the biggest boost. And this can be supported by the fact that we have seen that corporate profitability has been very, very buoyant this particular quarter. Because of lower input costs, we have seen profits growth of over 20%. Second part is in terms of construction, we have seen a lot of buoyancy in terms of construction, given supported by the government capital expenditure, as well as the housing sector, which has done very well. So I think these two are the segments which have actually propped up. The others have sort of played the regular support role and ensured that we've gotten this number of 7.6%.
Unlike expectations, services growth contracted to 5.8% in the second quarter, the lowest number recorded since the first quarter of FY 2023. The growth in private final consumption expenditure, which is taken as a proxy for household consumption, slowed down to 3.13% in Q2 from 5.97% in the previous quarter. One of the reasons could be the slowdown in rural demand. The central bank has kept the Q3 GDP growth forecast at 6% and for the last quarter at 5.7%. For FY24, RBI has pegged India's GDP growth at 6.5%. In light of the Q2 print, how will growth fare in the second half and for the full financial year?
As economists, we always tend to be cautious in terms of our views. So I think even though we've gotten this number of 7.6% for this quarter, first quarter was 7.8%, we would tend to be a bit cautious. The reason being that we have seen that the Kharif output is supposed to be lower than what it was last year. This is something announced by the Ministry of Agriculture. So that is something which is going to play on in the third quarter. In the fourth quarter, we know as of now, the Rabi crop is not doing that well. The reservoir levels are down. So therefore, there could be an impact even on the final numbers for the Rabi crop. So agriculture is going to be one area which we'll have to look at more cautiously. We may not be getting that 3.5% growth, which we normally take for granted. Now, along with this, I would say that the other sectors would depend a lot upon what happens to consumption. That is both rural demand as well as urban demand. We have seen that urban demand has been good, but rural demand needs to catch on, and that's not something which we have seen happening. So this said, I think we can be confident that for the entire year, we would be in this region of 6.6%, maybe 6.7, 6.8, depending upon how these numbers turn out. It will be lower than last year of 7.2%, but definitely higher than the RBI projection of 6.5%, which they had for this year.
As of now, we are concerned that there will be an optical slowdown in growth prints in H2 compared to H1 because of a normalizing base, because of a bleak outlook for the agriculture sector and therefore rural demand, because of lower tailwinds from commodity prices, tepid global demand impulses, And also, we are concerned that the very high growth in government capex that we saw in H1 will slow down as we get closer to the general election, especially as we get closer to the model code of conduct. And for the month of October, in fact, Government of India's capex has contracted in YOY terms. So we do think that growth prints in H2 are going to be 5% or thereabout. So much lower than the 7.5% plus that we saw in H1. For the year as a whole, because Q2 surprised on the upside, we revised our growth estimate for FY24 to 6.2% from 6%.
And what will be the likely drivers and roadblocks in India's economic growth for FY24?
One clear roadblock is going to be agri and rural demand. So we already got a weak 1% ish print for agriculture for Q2. And Q3 is actually where the Kharif harvest comes to market. And looking at the advanced estimates that we've got, which are pointing to a contraction across all the major Kharif groups, hard to believe that we're going to get a print which is better than this for Q3. And capex I already talked about. I mean, I think that is clearly something that is going to see much lower growth prints from Government of India in particular in H2 as compared to H1. In terms of drivers, we do think that urban demand broadly is going to be sustaining. Like I said, there may be some timing mismatches between the end of the festive season and some amount of tempering that we see immediately after that. But on urban demand, more broadly, we remain constructive. It's rural demand where we are a little conservative. And for state governments, last year the base of their capex in H2 is actually very, very high. So on a big base, perhaps growth is going to slow down. Growth was very high at 50% for state government capex in H1, and we certainly don't expect that to be replicated in H2. But if they're even able to maintain about a 10% growth over what they had done in H2 of last year, then that is something that will still drive growth, even though the momentum is something that will moderate.
Experts agree that while the Indian economy may continue to see strong growth on the back of robust urban consumption, it is the rural demand that may slow down the growth momentum for the second half of the current financial year. A spike in prices driven by the El Nino phenomenon and a likely shortfall in Kharif production are seen affecting rural demand. A likely slowdown in government capital expenditure ahead of general elections is also seen moderating GDP growth in H2.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.